In this week's Maximize Your Medicare Weekly, we've got a new segment that I call Big Deal, Little Deal, No Deal. In addition to that, we're going to take a look at life insurance, the video that I released a couple of weeks ago. We got two new examples proving my point. And third, we'll look at financial markets very, very briefly. Let's go. Hi, everybody. My name is Suze O. I'm the author of this book, Maximize Your Medicare, 2020 edition, available everywhere, amazon.com, your local bookstore. Check it out. The website for the book, www.maximizeyourmedicare.com. Okay, so this week I've going to show you the newsletter. The newsletter, which can be subscribed to. If you want to get it directly to your inbox, please do that. You can find the link and the text below the video. Anyway, what you can see here is we've got a couple of special announcements. First, a reminder here about this virtual event. This virtual event, you do need to have pre-registration. My capacity is limited. Okay, as people know, people understand how Zoom works, et cetera, and all these video conferencing platforms. The number of people that I can let in is going to be strictly limited. Once we get to that point, I'm going to have to shut it down. So please do that. I'm going to review Medicare, all of the parts of Medicare's enrollment, eligibility, Part A, B, D, Medicare Advantage, Medigap. And then finally, I'm going to be talking about mistakes that people make when they're planning for Medicare. There'll be plenty of time for questions. I'll be able to answer them live. But again, remember, you do need to register in advance. I do expect us to hit capacity well before October 5th. This week, we've got a number of headlines, as usual. There are always headlines about Medicare, right? The reality is that it's very difficult to tell from all of the noise. Headline, your eyes glaze over, you see one, okay, does this affect me? You're not really sure. I'm going to try to make it easier here. And I've introduced this segment and I call it Big Deal, Little Deal, No Deal. So the first one, it came out a couple of weeks ago. It has to do with the fact that the president had tried to sign over 4 executive orders to try to help lower prescription drug costs. Now, this is one of those issues that actually gets bipartisan support. There are actually 2 issues in healthcare cost planning concerns, if you will, health policy, that we do actually have bipartisan support. One is lower prescription cost. Number 2, surprise medical bills. This one addresses the prescription cost. Now, there are 4 separate measures to try to, combat this. And the reality is I call this little deal, almost no deal. Because, first of all, the lowering of prescription costs involved in these 4 measures really are focused on the medications you get as part of Part B, medical services. So, for example, if you went into the doctor for infusion services, okay, chemotherapy, and there is a particular medication, then yes, then it will help you. But for the vast majority of people, when they go to the drugstore, your local pharmacy, or your national-based pharmacy, whatever that might be, without naming names, the reality is none of these measures really affect you, okay? The last thing is, there are some other measures in here that are almost impossible for everyday people to understand. But the reality is that they have some preconditions, and these preconditions are pretty big. So it's kind of like saying, well, we'll do this if you can prove me that. Well, if you can never prove me that, then you never get, then the thing is toothless. So as a result, basically, that's why I call the executive orders on prescription drugs little deal, almost no deal. Although, again, not to everyone. If you go into the hospital, if you go to a healthcare setting and you get administered prescription drugs and you are billed under Medicare Part B, this should be helpful. Pre-authorizations for Medicare have generally not been the story, right? For Medicare Advantage policy owners, you're used to this. Prior to the age of turning 65, you're used to this. This has been the standard practice, right? Which is that if you had a particular medical procedure, a particular test, costly, expensive test, CT scan, for example, and if it wasn't part of, the normal essential health benefit, then you could have fully expected a pre-authorization requirement. And then it goes in front of the insurance company approves it, and then you can have it. That's what happens pre-65. Under Medicare Advantage, a similar type of thing can occur. So again, for newcomers, under Medicare Advantage, remember, the Medicare Advantage carrier is running the show. They get to make every determination. They're the ones who determine your copay. They're the ones who determine your deductible. They're the ones to determine your coinsurance for in and out of network providers. That's not necessarily negative. Remember, you can watch umpteen many videos that I've created about Medicare. The fact of the matter is, this book, it's basically telling you that the competition in the practical world is so fierce that the carriers have actually moved this lower in the buyer's favor, the policy owner's favor. That's you. Nevertheless, pre-authorizations under Medicare Advantage have occurred. That's not what I'm talking about here. What I'm talking about here is if you don't have Medicare Advantage, then original Medicare does now have a list of pre-authorizations for outpatient hospital services. Okay. Right now, there's a list of only 5. I've included the link to the article, which actually states what those are. We won't get into them. Otherwise, we'll have like a 5-hour video. This is not that big a deal because it's 5. So that's why I call it a little deal for now. For now. And the reason it's only for now is the thing you need to watch for, the thing you need to look out for is no one said it's going to be limited to 5 and only 5. Maybe tomorrow it's 10, maybe tomorrow it's 20. That we just have to wait and see. I would call this third item big deal, which is that Medicare Advantage is now going to be available starting in 2021 for those patients who suffer from end-stage renal disease. This is pretty big, largely because, as people may or may not know, ESRD involves dialysis, and dialysis is very, very expensive. Now, the way that Medicare Advantage works today is that if you are an ESRD patient, generally speaking, you are ineligible to enroll in Medicare Advantage plan. This has caused great stress for many. Why? Because original Medicare and ESRD is very expensive. And without a Medicare Advantage plan, you would have out-of-pocket costs for the 20%. And this 20% of a big number is huge. This will create, however, in 2021, this is going to change, meaning that ESRD patients will be able to allow into Medicare Advantage plans. And this is enormous. We'll have to see, and I can anticipate already in October when clients come to me, excuse me, when clients come to me, they're going to be asking me, Jay, what is the best plan to handle ESRD in my location? And I'm going to be spending a fair amount of time here. And the reason I'm going to be spending that much time is because I'm going to be very aware that, number one, I would expect carriers to vary pretty wildly. In other words, plan number 1 in your area versus plan number 30 in your area, the copay, the co-insurance, in other words, the cost that you will incur, I would expect to vary from plan to plan, especially in 2021. And the reason is because the competitive forces are that carriers are watching each other. So the reality is, since 2021 is the first year, they don't get to look at each other here either. So as a result, there's not going to be a kind of a market agreed upon price. So as a result, I expect 2021 to be pretty volatile from amongst all of the different Medicare Advantage carriers. This is going to mean that choosing the right Medicare Advantage plan, if you are an ESRD requiring dialysis, is going to be very, very important. There's a special segment of persons who are on ESR who require dialysis, because this is one of the groups of people that can qualify and enroll in Medicare prior to the age of 65. And this is vital, because the reality is the most practical way, the cost minimizing way for persons on ESRD is to enroll in Medigap, either at the time that you're 65. The issue is there's no federal rule to make sure that people can purchase Medigap prior to the age of 65. That is handled by the states. And the different states handle this very differently. In addition to that, the premiums for persons under 65 to purchase a Medigap plan are much, much higher than they are for a person who is newly turning 65. You can expect multiple times higher. Okay. So again, I refer us back to the other video. I have a video about disability and Medicare. Now, actually, I've got to redo that, or I've got to amend that video, because now a viable path beginning in January of 2021 will be to enroll in Medicare Advantage. For those people, this is not only a big deal, this could be huge deal. Sometime over the past few months, couple of months, I want to say, maybe it's only the past month, you see the video here that's showing up on your screen. And I'm talking about life insurance ads. If you go everywhere, radio, TV, social media, you'll see a life insurance ad. And the reality is that the video basically takes a look at some of the claims made on those ads and tries to determine whether or not, it's correct. So literally yesterday, I was looking on my phone on Facebook, and sure enough, up came these two ads. So let's just take a quick look at them, real briefly, okay? Anyway, the first one is there, as you can see, Fat Fabric. 40% of Americans don't have life insurance. Not exactly sure where they got that. That's fine. Let's presume that's true. And now that's how to apply for term life insurance. Answer a few easy questions, get your decision, and of course, customize your policy. You can see premiums down there. Now you can see the small print, right? Everybody read the small print? Prices shown for a 25-year-old in excellent health. 25. Okay, so I'm not sure about you when you were 25 years old. One of the last things I was thinking about was buying life insurance. Right? I didn't have any commitments at that time that would require life insurance. That didn't mean that it was a bad idea at that time. Okay, but I also didn't have an income that I was trying to pay the rent at 25. I can remember those days very, very well. When I lived in Manhattan, I lived check to check. Sorry, I didn't have a penny for term life insurance. Okay. This one, however, at least is kind of telling you, well, is it a few easy questions? Yeah, for a 25-year-old in excellent health, it'll be, very easy. And again, remember, this presumes that you are 25-year-old Mr. or Miss Perfect. Once you start getting older, once you start having a medical history, okay, these things have stopped being true quickly. And the variance, in other words, the distance, the different pricing you can get can also vary more wildly every time each one of these factors changes. All in all, though, I'm going to say, okay, this is just an advertisement. The one I have an issue with, however, is this second one. And you can see this is, Policy Genius. And full disclosure, I don't know anyone at Fabric. I don't know anyone at Policy Genius. I don't have anything personal against any of these people. I don't know them from Adam. Okay. But this kind of simple infographic, well, lack of infographic, I should say. Distort graphic. Is there a word? Distortographic. Anyway, let's just take a look at this. Affordable rates. Yes. Here, my issue here is this left column. I told you in the video, you can go and watch it. Look, if you want to get term life insurance and you're 25-year-old Miss or Mr. Perfect, if you're 35-year-old Miss or Miss Perfect, affordable rates by the other guys, and I could be one of the other guys, right? We're the same as Policy Genius. I'm pretty sure. Why? Because I can find exact ties in the marketplace. Easy quote comparison. Of course, I have the fiduciary responsibility to give that to you. So how are these under the other guys as the sad faces? Unbiased advice. Okay, here's the issue, is that somebody's trying to tell you that they're unbiased. The implication here is the other guy is biased, right? Isn't that the implication? And this is not the only avenue where this occurs. It isn't. Don't get me started on Medicare, because I can tell you that certain agencies in the world say they're unbiased. Guess what? I have to be unbiased. See all these letters after my name and all these permissions that I have with all these companies? I have to be unbiased. Simplified application. Again, maybe, maybe not. Meaning that as soon as one of those factors moves, it all of a sudden goes from simplified application to not so simplified application. So for this one, Policy Genius, you're awfully close to see me after class. So don't talk too much about this type of topic, very often. But I want to take a look at financial markets just for a moment. And this is not financial advice. What it has to do, though, is dealing with the information that you are given on CNBC, see it on the internet, one-line little quotes that seem like snappy and seem like quite logical, until you take away just a single layer of the onion. And here it is right here. So the United States 10-year government bond is pretty much the benchmark for the entire world. And right now, you can see here on your screen that its yield is 0.53% per year, almost a closing record low. Okay, it's not as low as it was intraday during the worst of March, but it is very, very close to the record, 0.53% per year. And you can see on the press that you'll see people saying, don't invest in U.S. government bonds because the yield is too low, and you see extreme stuff like, well, that's like setting your money on fire. Let's just take this doesn't take into account a couple important facts. And these other facts are me taking away this layer of the onion. Number one, there is a record amount of debt in the world that is negative interest rate. Negative. Meaning that if you deposit $10,000, you lose money for sure, just on the interest. alone. In fact, in Bank of Ireland, if you have your national pension fund, or if your pension fund is sitting with the Bank of Ireland, that pays minus 0.65% a year. Minus 0.65% a year. Okay. The second thing is that you can't take any single item, any single statistic in isolation without a context, without an idea about where the rest of the world is in this case. And the reason for this is that the United States, we don't live in a bubble. We don't. Financial markets are global by nature. There are investors everywhere. These investors are huge. Okay? They're scouring the planet to look for portfolios so that they can pay the national pension funds. Okay? Let's just take a look. So in the United States, you can see here, I'm going to try to, I try to put it in blue there at 0.53%. Low, no question. But then you take a look at the rest of the world and you see Germany. Now, no one would question Germany's place in the world, but you can see it. Very high quality country in terms of credit rating, minus 0.53%. Is it? Yes. It is more than 101% lower than the United States. So the idea that the United States this 0.53% can't go lower, maybe you should think twice. And you can see it as you continue to look down on this screen. I'm looking at Germany. You see the United Kingdom, 0.1%. Switzerland, 0.59%. Japan, 0. Where it has been for basically a decade and a half. So it's a very important thing to not take a single piece of information in isolation. And again, just go ahead and click around. You'll be able to see 0.53% US government bonds are like setting money on fire. Not so fast.